Covers the housing market for us. For more on real estate, David Auerbach joins us. He is the CIO at Hoya Capital. Hoya specializes in managing portfolios of publicly traded real estate securities. You have your own ETF, REIT, right? R-I-E-T rather than R-E-I-T. Talk to us about the, if we're at a low, if we're maybe at an inflection point here for real estate investing.
Well, if you talk to the publicly traded REIT guys, they would say that we've, on the way to turning the corner. Looking at previous cycles, a lot of these REITs have been able to hunker down, improve their balance sheet, lower their leverage, dividends are increasing, earnings are increasing. And so by and large, even though we hear these headlines of doom and gloom, commercial real estate, wall of debt, all of these negative headlines, talk to the individual REITs themselves and they're like, no, fundamentals are strong. We're able to properly manage our debt stack over the next few years, focus on the operations, and look at the bigger picture.
Right, and this is kind of what we heard from Bill Gross on the close last week. He was talking about, regional banks that he thinks already have put enough aside to deal with any fallout. But in terms of the price action, I mean, it can be doom and gloom. If the price is down far enough, it's a good entry point, right? Do you see that across the space?
Absolutely, especially in some of the small and mid-cap REITs. We think some of these guys are extremely, frankly, deep value plays. If you look at across the 11 GIC sectors, real estate, the bottom performing sector. Look at year-to-date performance, real estate, one of the worst sectors. But yet, again, FFO, the REIT earnings number, continues to go up. Dividends continue to go up. Over 50 REITs have raised their dividends so far this year. We focus on the REITs that pay the highest dividends with the lowest leverage ratios. And so we kind of ignore this wall of debt looking at the individual constituent level.
The GICS sector, that's a jargon alert is what Tom Keene would have said back in the day. You're talking about the
S&P
industrial breakdown on the S&P.
Yes.
We can pull that up on the Bloomberg terminal with the GRR, the group rank returns. If you look at it year to date, you're right. It's the biggest underperformer. It's the only one in the red here. You can see real estate at the bottom. Obviously, IT and communication services are there at the top. REITs are not a monolith, right? This country is broken down into many different regions that are all performing at different levels. Where do you see the winners and the losers in those terms?
Sure. So if you look at on a sector by sector basis, obviously some of the sectors like industrial, single family rentals, data centers, those sectors have been on fire. If you look at regions, Sunbelt apartments obviously been in focus, Sunbelt industrial, where Amazon goes, that's kind of dictates where things are heading. And so in certain cities as well, like New York, there's pockets of strength, there's pockets of weakness. I mean, it's almost on a sector by sector or a street by street basis. Perfect example is Blackstone. Blackstone, in one hand, is buying in certain markets, and in the same markets, they're selling assets. Right. Look at what's happening with their private REIT vehicles, both with Blackstone and Starwood. And because of what's happening in some of these vehicles, this provides that opportunity for some of the publicly traded REITs to potentially acquire some great assets at great prices because of the strength of their balance sheets.
Right. I see it. I'm from Granville, Ohio, and Intel is building a huge plant right down the road from us, and as a result, home prices in some places have just, doubled.
But it's also going to lead to more apartments, more single-family rentals. I was in West Village yesterday looking at Google, Apple, Samsung, all of these new companies that are moving into the area, but there hasn't been a big residential component that's followed along with all these companies going. And so when you kind of look in the microscope or the crystal ball of 5 years down the road, West Village, as an example, is going to look completely different on the resi side than it does today. And again, it's going to be some of the publicly traded REIT guys that are the driver towards that.
In terms of commercial real estate, I mean, people describe it as a slow motion train wreck, right? I think Bruce Richards from Marathon was on the close yesterday saying it's the story of a python swallowing a pig. How far along is that pig?
I would think, especially since the REITs have been in this higher for longer, not just high for long environment for a couple of years, we're operating in an environment where we know there's only going to be maybe one rate cut this year, maybe. And so as a result, I'd like to think that we're pretty far along in this beat-up situation, especially for those companies that are exposed to variable rate debt. Since so many REITs have a huge component of fixed rate debt, they're able to navigate these waters pretty easily right now. Obviously, should we see an uptick in rates or things turn, then obviously, again, the variable rate situation changes. But from where I sit, the 10-year Treasury is trading around, I believe, 4.25 right now. The average REIT dividend yield, when you include mortgage REITs, is around 6.9%. So that gap is widening between REITs and fixed income. For us, running the high dividend yield REIT ETF, when you also include the layer of preferreds, we're paying an index dividend on a monthly basis that's annualized over 10%, because we're seeing opportunities in small and mid-cap REITs, in mortgage REITs, in preferreds. We just take a completely kind of contra approach that some of the large cap, equal market cap weighted players do.
How much do rate cuts matter, and what do you expect?
I mean, dramatic. I think, as I like to say to folks, when the Fed announces the rate cut, hopefully whenever, September, December, when they make that announcement at 2 o'clock, at 2 o'clock in 1 second, the REIT sector immediately responds. At 2 o'clock in 2 seconds, when the advisor calls their client to be like, hey, the Fed cut interest rates, it's time to buy REITs, that ship has already sailed. So it's our job to try to educate investors and advisors why it's important to start increasing or positioning towards REITs today for what's inevitably coming down the road tomorrow.
All right, David, great to get some time with you. Thanks so much for coming into the studio here. David Auerbach there of Hoya Capital. His ETF is REIT. RIET, sorry. RIET, so the opposite of REIT.
Because income comes first.
Income comes first. All right, great pitch there. Coming up, the morning calls, and then later, Invesco's